The Dow soared to a record-closing high today after the Fed signaled rate cuts could come next year. For more on the Fed, let's bring in Krishna Guha. He is vice chairman at Evercore ISI. Krishna, it's great to have you on this Fed day. I think heading into this, you had been maybe perhaps more cautious that the market was expecting too much from the Fed, that the Fed may even lowball what we're going to get next year. How do you see it now?
So I think the Fed came out significantly more dovish than I was anticipating today, full disclosure. You saw the Fed signal a baseline median projection of 3 cuts next year rather than 2. That might have been influenced by the most recent PPI data this morning. That will have led them to realize that what looked initially like a somewhat firm core CPI print this week was going to map into a lower inflation read on their preferred PCE measure. But bottom line, there's no doubt that even before that, they were transitioning, reorienting towards rate cuts a bit faster than I had anticipated. And Powell's press conference, I think, was really dovish right across the board. Almost surprisingly so, in the sense that there was no effort to restrain financial conditions from easing sharply further, which they have. But he was very optimistic about progress on inflation and talked about how that discussion as to how long to stay on hold and when to cut is starting to get going on the committee.
So is pivot the right word to use for the messaging from Powell and in terms of the dot plot today? And is March now on the table as a possibility for cuts, assuming that inflation continues to move in the right direction?
So it is a pivot. I mean, a pivot's a process, maybe not a single day. The Fed oversteered way too hawkish in September. We said that at the time. They've course corrected now in December by a little more than I was anticipating. So certainly, I would say, maybe the early stages of that final pivot are now starting to roll. I think Powell was still not leaning towards March. I think if you look carefully, there are signs that he's leaning more to Q2 than to March. So a couple of things there. One is they continue to describe inflation as elevated in the statement. Another is that instead of retiring the hiking bias outright, they did a sort of halfway step, referring to any further tightening that might be required. You'd expect that language to have to transition further in the dovish direction before you're really zooming in on rate cuts. And that plus the need to see, as he said, some more evidence on inflation, wages as well, seems to point more to a June or May first cut than March. But I think it's certainly fair to say that March cannot be excluded on the basis of today's communications.
Yeah, there was that Fed hawkishness, but it was a transitory hawkishness. You say this should fuel the risk rally, and you say it in a way that makes it sound like investors shouldn't chase it, no?
Oh, no, I think, to be honest, this is something that you want to get on board with. The Fed can't believe its luck. I think that's what's really the case here, right? The data is going their way faster than they had possibly contemplated. Here's one example of that, really telling example. 3 months ago, the median Fed official thought core PCE inflation, their preferred measure, was going to be 3.7% at the end of this year. 3 months later, they're estimating it's going to be 3.2%. That's a huge, huge improvement in the inflation outlook. In other words, they were too hawkish beforehand. We said that. But the data has come in so good that they're not just making a small adjustment. They're making a much bigger adjustment to their assessment of where we're going to be on inflation at the end of this year. When you look at the 6-month annualized measures, they're showing a lot of improvement, which will slowly, of course, pass into that 12-month annual measure that is still, capturing some of the lagged effects of the earlier inflation heat that's really over